National Life has been just a tremendous carrier for us. They've come to the forefront, and they've worked diligently to try to get all of our Kaizen products the way we want them. And we didn't really realize we were marketing Kaizen without even knowing what living benefits were. And so when David Gilmore kind of educated us, the light came on. And you'll find that when you touch base with a client on living benefits, when they buy that contract, they will never want to let it go. Imagine, because they would say, if I let that go and I have a heart attack, I'm in trouble. Or if I have cancer, I'm in trouble. And so the living benefits is more of a greed sale because it's about the insured rather than the beneficiary. And so I'm going to have Dave. Where is Dave? Over there. Come on up, buddy. David Gilmore has been tremendous asset for our agency. He helps us all the time. He knows the product. He's a professional. David Gilmore, give him a big hand.
Professional?
Yeah, somewhat, yeah.
Professional is a nice touch. Thanks, Dave. Well, good morning, everyone. Thank you for being here. I really appreciate it. I'm so excited to be here. I'm so excited to see how big this room has gotten. Dane and Grace and the whole team has done a phenomenal job. Like Dave said, we've been partners with NIW in the Kaizen program since its inception, and we've been really excited about the results that we've seen. It's a really exciting program. It's definitely a niche play, but in the right situations, it can make the most sense. And as Dane talked about yesterday, Dane and Todd both, one of the most important things about having a permanent life insurance product is that you fund it properly. And most of the people that you will talk to, the professionals, the business owners that really know that they need the life insurance and want the protection, struggle with coming up with the disposable income to fund these contracts really the way that they need to. And it's always been a find the money game. And so with Kaizen and ultimately with Trizen too, it's a find the money solution. And so we can help them fund these products the way that they should. So I can't wait to see what this room is going to look like next year. I don't know, you're going to have to move it somewhere else, I guess. But seeing the activity, what we're seeing in the home office with the interest is just phenomenal. So I can't thank them enough. They've been a great partner of ours for a very long time. So what I'm going to talk about today, I'm going to talk just a little bit about National Life Group. If you're not familiar with National Life Group, I urge you to learn a little bit more about us. We really have had a phenomenal run this decade, and I'm going to talk a little bit about that. And then I'm really going to focus on our living benefits, because lots of times people will poo-poo them as not being valuable, clients not seeing the value in them. But when you really start to look at what they can do, because again, at the end of the day, it's not what it is, it's what it does that's most important. And if you're ever looking for something that's going to push someone over the edge, sometimes our suite of living benefits will do that. So I'm going to talk a little bit about them. I'm going to give some examples. I'm going to talk about what we've seen from a claims history perspective. And then I'm going to wrap up with what I refer to as our fifth living benefit, which is a unique distribution option in the life insurance industry. So without any further ado, let's get into National Life Group. I'm going to share a couple of numbers with you. At the end of the day, the big thing that I want you to take away is that National Life is as financially sound as it has ever been and continues to grow every year. As evidenced by the fact last year, S&P actually upgraded us, which is pretty much unheard of in the life insurance business in this era, that you get a full upgrade from a rating agency, especially S&P. S&P is probably one of the hardest agencies on us as a company. So for a 168-year-old mutual company, getting an upgrade from S&P is phenomenal. You know, everybody thinks about National Life Group as this sleepy mutual in Vermont, but I will tell you, we've been kicking butt for the last 10 years, and people are starting to take notice. If you read the S&P review of us as a company, they refer to some very significant things that we've been able to do. Diversification in sales, diversification in distribution, risk management, and asset management. Those are all the things that they looked at us and said, you guys are doing as well as any other company out there in taking care of those very important things in this business. And because of that, we're going to give you an upgrade. So these numbers, you can see all these numbers on the website. I'm not going to bore you with all of these, but one of the things that I did want to share with you, because we are really proud about this, and that is that we are the fastest growing life insurance company in the United States since 2010. And I tell you that not to be braggadocious. I tell you that because it's not because we're giving away the farm. We're not cutting our underwriting. We're not paying more than anybody else. We're not creating products that are not sustainable. We're doing everything in a very responsible manner, and we're still growing. One of the reasons I will tell you why we are growing as much as we are is that we partner with companies like NIW that have niche products. They have niche products and concepts that no one else is doing in the marketplace. And they help people that need that the most. I mean, what we're talking about with most of the things that NIW does is the emerging affluent and affluent market. And especially in the emerging affluent market, there's a lot of people that are ignoring that market. And so the solutions that NIW has come to us with focus on that market, and it's really important. It's meeting a significant unmet need. Because if you look at all of the industry statistics, people will tell you they know that they need more protection. They need more insurance. They need more coverages than they have. But they don't do it because they don't think they can afford it. And so what we tried to do is if you go back to when we started creating these products back in the late 1990s, what we looked at the needs of the American consumer. And we really tried to build a product portfolio that was driven by consumer demand. And so what I'm going to talk to you a lot about today is just that. It's that consumer demand that has driven the product portfolio that we have created. The other thing that we've done over the last 7 years, is that we've moved up in size or sales, according to LIMRA, from 32nd to 18th. So we're now the 18th largest writer of individual life insurance premium in the country, which is pretty impressive for a company that's our size. And we're really proud of that. The other thing that we're really proud of is that we keep our promises. Last year, if you saw the first number 2 slides ago, it was total revenue of $2 billion. We actually paid out over $2 billion in benefits last year. And we still had record income, record assets, record capital. So we're doing things the right way. What we set out to do, take care of our policyholders, we're actually doing. And we're really proud of those numbers because that means that we've put $2 billion back into the hands of our policyholders. And that's what they count on us. They count on us to be there when they need us the most. In retirement, death, illness, that's when they need us the most, and that's when they want us to be there, and we're really proud of that. So all of this is accomplished just because of this one little story. This is our marketing story for all of our products. We have protection in case you die too soon, get sick, or live too long. And that's across our entire product portfolio. And I bring this up first because I will tell you, along with diversity in product, diversity in distribution and all that stuff, it's all great, but we keep it simple. And in our business, you all know, simple is really hard. Now, I'm not saying that we've figured out a way to make operationally, everything simple when you send us an application and the whole underwriting process and all that kind of stuff. No, we still haven't cracked that nut. I don't think anybody's cracked that nut. But from a marketing perspective and from a product positioning perspective, we're trying to keep it simple so that when you see a product, you know what it does. You know how to present it to our client. So with that said, everybody, you wouldn't be here if you didn't know what life insurance does. It pays a death benefit when somebody dies, right? That's the old kind of insurance. The old kind of insurance, you paid a premium, somebody else got some benefit. The great thing about our living benefits is it appeals a little bit because, let's face it, purchasing a life insurance is a very selfless act. You're paying a life insurance premium so that somebody else benefits from those expenses, right? The death benefit is going to somebody else. If I'm the insured, I'm never going to enjoy the death benefit. There is no way, unless I'm reincarnated, and I don't think we've been able to figure that out yet. So somebody else is going to benefit from what I'm doing. And that's a great thing. It's very selfless. But at the end of the day, when you're asking someone to spend $50,000, $75,000, $100,000, $200,000 in premium, it's nice to appeal to their selfish nature as well. And that's what the living benefits do. The living benefits answer the question, what's in it for me? And what's in it for me is some protection should something happen to me. And so that's really what I want to spend some time talking about today, is our four accelerated benefit riders. We call them living benefit riders because they're there while you're alive. Terminal illness, chronic illness, critical injury, and critical illness. So we're really proud of these. We really try to keep on the cutting edge of the living benefit product development process. We try to keep our riders as fresh as we possibly can. So I'm going to talk a little bit about these, but before I do, people always say, well, we've never heard of living benefits. You know, they're too good to be true, all this kind of stuff. And I found one of our marketing guys showed this to me a couple of years ago. Actually, it was a bunch of years ago. But this is an ad that National Life took out in Saturday Evening Post in Time in 1937. And if you read the bottom of it, it says, grandfather never dreamed of living benefits. That's pretty amazing when you think that that was 80 years ago that came out, and we're still talking about living benefits as a company. So when you talk about companies that are on the cutting edge and really are looked upon as innovators in this marketplace, I will tell you there's no one that's been doing it any longer than us. I will also tell you that when you look at the marketplace, because we were really the ones that created these living benefit riders back in 1998 in their modern form, everything else out there is just a copy of what we've done. And that's why we pledge to stay on the cutting edge of those designs. Because we put a stake in the ground back in 1998 that this is what we were going to do. We were going to make sure that our products did more than just pay a death benefit. And that's what we've been doing. So, as you listen to these, if you are not familiar with them, I'm going to give you some examples. I'm going to tell you how they work. I'm going to show you some actual claims. You know, the numbers are just random policies and random amounts of benefits that people got. So just keep in mind that depending upon the size of the policy that you're offering to your clients, you can show them larger, smaller benefits depending upon what they're giving. But before I get into the specifics, why are these important? Why should your clients care about these benefits? Because healthcare is expensive. And as we heard yesterday at lunch, one of the things, especially with wealthy people, one of the challenges that they face is that they are asset rich and sometimes cash poor. And when you look at the amount of dollars that these riders can put in people's pockets, it certainly can alleviate a lot of stress that comes from an unexpected illness. So just some stats, you know, it costs $77,000 to stay in a nursing home. Strokes are the leading cause of disability. As a matter of fact, there's a stroke every 42nd. Men have a 1 in 2 chance, women a 1 in 3 chance of developing cancer in their lifetime. So it's not if, it's when for most people when they're going to experience one of these issues. 1 in 8 people with advanced cancer turn down recommended care because of cost. The cost of a severe heart attack, and this one blew me away when I saw it, is $1 million. $1 million if you have a severe heart attack. That's insane. Most people can't even fathom that. Most people don't know what's going to happen if they don't get next week's paycheck, let alone, you know, experience a severe illness like this. And now we're doing a great job of making sure that people recover from these illnesses. You know, it used to be that you had a severe heart attack and you never recovered, or you had a severe stroke and you never recovered. Now the chance of survival has escalated. Medical advances has created a medical environment for us that means that your chance of living is much greater than it ever was. And so when you live with one of these illnesses, it creates expense. 1.5 million Americans will declare bankruptcy this year, and 60% are due to medical bills. And of those 60%, 3/4 of them have health insurance. So we're not talking about uninsured Americans that are filing bankruptcy because of medical bills. We're talking about medical bills that are increasing their debt, reducing their income, and creating a situation where they have no alternative but to declare bankruptcy. And it means that they lose everything that they've worked for. Chronic illness, again, it's really expensive. Anyone that has dealt with this, and most everybody in this room, has known someone that has had heart attack, stroke, cancer. And you all know that illness had a significant impact on that family, regardless. You're not going to have one of those issues today and go back to work tomorrow. It is always going to create an unknown expense for that family. And depending upon the severity and depending upon the coverage that anyone might have, it creates a big unknown and a big risk that everybody faces. So let's talk about these riders and exactly how they work. We all know that it happens. We all have seen people. We've all seen the devastation that one of these illnesses can bring to a family. So how do they work? I'm going to talk about them kind of in order of ease of understanding how the benefits work. Because at the end of the day, one of the things that I always get asked is, well, these things are great, but how much do they increase the cost of my policy? They don't. There's no priced cost of these policies. And I know yesterday it was said, if you're not paying for these benefits, they aren't worth anything. Well, pay attention to some of the claims, specific claims that I'm going to give you, and ask yourself, even though that client only paid for the life insurance contract, do you think their family was happy that they got the money that they got, even though they didn't pay for it? My guess is that most of those families were pretty happy that they got those dollars. So terminal illness, 24 months to live, no waiting period, you get a lump sum distribution, funds can be used for anything. And we'll give, depending upon the size of the policy holder, $1.5 million in cash. So if they have a large enough policy, we will stroke them a check for $1.5 million. Now again, if you're selling a $500,000 policy, they're not going to get close to that. But you have an affluent individual that maybe has a $20 million policy and they have a terminal illness and they want to do some things before they pass away, getting a check for $1.5 million will impact almost every single person that has that illness. That's a huge amount of money. And again, they can do anything with it. And if they use it for, say, experimental treatment and they're healed, great, they live. They don't have to, we don't look to get it back. It's their policy. So the rule is that you can accelerate any percentage of the death benefit you want. So if you have a $2 million policy and you want to accelerate half, you can. It's not a percentage. What we do is we discount the death benefit. What we're looking to do, and the reason that there's no explicit price for this or cost or any impact on policy performance whatsoever, is we're looking to put the company in the same position whether we pay a death benefit or a living benefit. And the easiest way to see that is an example like this. This is a terminal illness illustration. So the guy had a $108,000 policy. He got full acceleration, $100,532. So basically, think about this. Someone that has 2 years left to live actually has a life expectancy of 3 years, believe it or not. And so all we do is we look at how much interest are we giving up? How much money, if we pay today, are we giving up in interest if we pay that claim 2 years early? And we make ourselves whole. That's it. That's what we're doing. So that's why we don't have to charge for it. We don't have to charge for it because it's a net zero-sum game for us. Whether we wait and pay the death benefit or whether we pay the benefit today because of a terminal illness, we know exactly what that's going to cost us. Now, is everyone going to die in exactly 2 years? No. Some people are going to die in 6 months. Some people are going to live forever. But based on the law of large numbers, which is what an insurance company does, we know what to expect long-term from these benefits. So that's what it is. So terminal illness, you get roughly 90% of your death benefit, depending upon, it's a little bit different for age and, how big your premiums are and if there's loans and that kind of stuff. It varies a little bit. And the illustration does a great job of showing you exactly what the benefits could be, but this is pretty typical of what you could see. And again, imagine someone that has a $2 million policy and they have a terminal illness and they want to do something today and they don't have the cash. Here's a way to get it. Chronic illness. Chronic illness is, I don't even want to say these words, but everybody understands what long-term care is, understands what the definitions are. These have similar definitions. That's its only similarity. This is not a long-term care rider. This is a chronic illness rider that allows you to accelerate your death benefit, a portion of it, should you be unable to perform 2 of 6 ADLs or have cognitive impairment. So what does that mean? We don't make you come in and say 2% a month. We give you 24%. That's our rule. 24% that you can accelerate every year. The policy does have to be in force in most states for 2 years. But states like California, the waiting period is down to 30 days. And there are some other states like that as well. So please check the website to make sure that you've got the right definitions. But at the end of the day, again, for chronic illness, $1.5 million. We'll give you $1.5 million in cash as long as your policy will last. Yeah? No, it's different, and that's why I did it in this order, and I'm going to show you an example so you can understand it. Yeah. There is a 90-day waiting period, but we pay benefits retroactive. So if you had, let's say your policy was 2 years old, you had a chronic illness today, you wouldn't get your first payment for 90 days, but we would give you a full 12 months starting with the day that you had the chronic illness. So, I'm sorry? So, most of the time, these riders have a phrase in there that says must be permanent. Ours does not. The expectation is that it's going to be a long-term illness, a chronic illness. Chronic illness, by definition, is long-term. However, so let me give you an example. Someone's in a car accident, they break their pelvis, they're in a cast for 6 months. Does that mean they can't do 2 of 6 ADLs? Yes, it does. Does it have any expectation of being permanent? No, because they're going to heal, they're going to get out of the cast, they're going to be able to move on. That's not a chronic illness. Getting hit in a car accident and being in a wheelchair with the doctor saying you may or may not recover, that's a chronic illness. Now, you may recover after 6 months, but the expectation is we don't know. And when we don't know, then we pay that. There is no definition that says a doctor or anyone has to certify that this is a permanent situation. So the question is, do we pay the first instance? Yes. So if someone has an event that causes them to be chronically ill, we pay it. As long as that same situation is in existence at the end of the 12 months, we'll certify them again for another 12 months, and again for another 12 months. No, it would not be covered. No, that's not, there's no expectation of permanency there. We're not saying it has to be permanent. What we're saying is we expect it to be a chronic condition, and that is not a chronic condition. Yeah. That's a great question. I'm going to show you an example in just a second so that you can see it. In the first example where we had a terminal illness, Dane? Yes, I will. Yep, Dane just asked me to do that. You guys are all, thank you. So the last question was, what happens to the policy when you accelerate? And I said I'm going to use an example in just a second to show you. In the first one that we talked about, there was 100% acceleration. So they gave up their entire policy. They traded in 108 for 100. That's what they got. So with chronic, it's a little different. So in this instance, they have a $512,000 policy. The amount accelerated is $122,000, and they get $89,000. So they turned $122,000 of death benefit into basically $90,000 of cash. Okay, so what's left? They used $122,000 of death benefit. So you subtract 122 from the 512, that's what they've got left. And every time they accelerate, whatever they've accelerated and taken the net amount, that's the balance. Okay? This is not a premium paying long-term care rider where it's a dollar-to-dollar reduction in death benefit versus benefits. This is an acceleration. Remember, we're looking to put the company in the same position, knowing the life expectancy of an individual at a certain age that has a chronic illness. We know how long they're expected to live. So we know how long we have to discount that benefit. Younger people with a chronic illness, more discounting. Older people with a chronic illness, less discounting. The expectation is someone that is young with a chronic illness will live longer than someone that's old with a chronic illness. Makes sense, right? So the discounting is different. Again, the illustration will show you at different ages what the client might expect to get. This is like the first couple of pages of our illustration. We illustrate all of this because this is where we get the most questions. And so we want to get it right out so that people can see it. Was there another question? Yeah. So the question is, what are the tax implications? Whenever a client accelerates a benefit, they should seek the advice of their tax and legal counsel. We designed these riders to be an acceleration of the death benefit. As an acceleration of the death benefit, we expect them to be paid tax-free. However, situations are different for different people. So they should always, when they're looking to do this, talk to their tax advisor. Because I can't, for every situation, give you a blanket statement that says, I guarantee that this will never be taxable. I can't. But remember, in these situations, this is an option for these people. The option is, okay, I can't work, I got too many bills, I'm going to lose my house. At that point, do the tax ramifications really matter? And I say that because we don't look at these for someone to have a minor illness and come in and cash out their policy. These are long-term benefits that they have in the life insurance contract. These benefits are meant to be used very carefully. Because remember, they're giving up the benefit in these contracts. It's $1 for whatever percentage they're accelerating. They're losing that percentage of death benefit. They're losing that percentage of cash. And if there's any outstanding loan balance, they're reducing that as well. The other thing that's great is we also reduce the cost of insurance because obviously they have less face amount now. So they have less cost of insurance. So the cost does go down as well. So we don't charge the same, we don't expect the same premium to come in once they've accelerated a portion of their death benefit. Whatever they needed to pay to keep it in force before, if they accelerated half of it, then they would have half of the charges in that contract moving forward. So the important thing that I want you to take away from all of this is that this is like a last-ditch effort. We're putting these plans in place for long-term planning purposes. But if life happens and something happens extremely detrimental to a person's financials and they need access to money because some illness has befallen them, this is a safety valve. It's a safety valve that they have on their policy that they don't ever have to worry about, it impacting the values or cost or anything. It's there. It's there for them to use. Yes, sir. So actually, the question is, in year 2, is it one of those things where you never can accelerate the whole policy? No, once you establish the 24%, we're going to do, the following year would be 122, or it might actually go up a little bit if this was like an option B contract and they were increasing cash as well. So all of these accelerations are based on the net death benefit. So it will take into account loans, it will take into account cash value if you have an option B contract, all of that stuff. The definition is you can accelerate these limits of net death benefit. Yes? So the question is, if they take the benefit, can they pay it back? No, they can't. And that's why it's really important that they make sure that they need it and this is the only alternative that they have. Because if you had someone that, let's say they had a critical illness is probably a better example. Let's say they had a heart attack and they accelerated a portion of their portion of their death benefit, and then they made a full recovery and the doctor said this has had no impact on your life expectancy whatsoever. The only option at that point would be to come into us and reapply for that coverage that they would have accelerated. Yes? I didn't think it would take that long to get that question. So the question is, what if this is under Kaizen, right? So there's a loan, there's an obligation on the policy to the lender of some of the premiums. Well, remember that in Kaizen, the goal is to always have the policy 100% collateralized by the cash value. So if all things are working the way that we expect it, the client could take a loan, pay off the bank, and then have a policy that they could fully accelerate at that point. So that's how it would have to happen. You would have to settle the loan, which you would have the cash value because we always expect it to be collateralized, and then you could accelerate the policy. Yes? So the question is, I said net death benefit. This says face amount. It probably is more accurate on this slide to say net death benefit at time of claim. So that's my bad. I probably should have been clearer on that slide. So the question is, if in this case they had a $512,000 face amount, they had $200,000 in cash. If it was an option B contract, then they would be able to accelerate the net death benefit, which would be the 512. So you can accelerate what the death benefit. So if you passed away today, what would we write you a check for? That's what you can accelerate. Does that make sense? So it doesn't matter if you've got cash in it or not, whatever the net death benefit is. So net death benefit is as it's defined by what will you get if you die today? Yeah, Eddie. I believe it does, yeah. Yeah, because you have less that you have to pay for. Okay. Whoops. I'm clicker challenged. So critical illness, and this is where we see the most claims, because these are the things that happen more often than anything. This is our list of triggering events. ALS, blindness, cancer, end-stage renal failure, heart attack, major organ transplant, stroke. You can see all of them. The difference with this is because, let's look at cancer. You know that there are different forms of cancer. You can have a very minor cancer that you can take care of maybe just with surgery, a little bit of radiation, and it's not really going to be life-threatening moving forward. But you can also have stage 4 pancreatic cancer, which that's not a really good thing to have. And so there are severities with each one of these. So the difference with this versus the other ones, you're either terminal or you're not. You're either chronic or you're not. This, even though you've had a triggering event, we're going to basically look at it and say, how severe was the illness that you have? If it was a major heart attack, it could be severe or even life-threatening. It could be, a very minor heart attack, no real damage, but yes, your blood enzymes showed that you had a heart attack, but it's really not going to impact you long-term if you do what the doctor tells you to do and, make sure that you change your lifestyle and all that kind of stuff. But that's going to be a very low or a very minor severity level. So this is really where you need to work with your clients. Because even though they may feel it's the end of the world because they have a heart attack and they want to cash in their policy, we may tell them, well, this had really a minor effect on your life expectancy. And so you're going to get very little. And so they really have to make a choice. Is it really worth giving up all of this death benefit to get this little amount of cash? Because there is that unknown nature in this rider as well as the critical injury rider, which I'm going to show you in a second. What we do is we take the claim, we look at it, and we send them an offer. So the client has an offer letter that we send to them. It's good for 60 days. If they decide they want to, they can accelerate. If they decide not to, there's no obligation on their part. And so they can test the water. They can put their toe in and say, I might need some money. And again, all these riders that we're talking about, there is no definition that you have to take X or you have to take Y. Even though the chronic is 24% a year, you could take 12, you could take 10, you could take 5. With the terminal, you don't have to take 100%, you could take 25%. With this, the same thing. We're going to tell you if you fully accelerate your policy, this is what you could get. You don't have to fully accelerate. Let's say that you just need, $20,000. So you only have to accelerate, a few percent of your policy. You can do that as well. Again, ultimate flexibility in the way that we administer these riders. Yes, sir. So are premiums waived? No, premiums aren't waived. What I said is the premiums are reduced based on the amount of death benefit that you're giving up. So if you give up half of your policy, your premiums, your required costs or your costs inside of the policy are going to be reduced by 50%. Now again, most of the policies that we're selling are not sold at minimum premium or just enough to keep them in force. The other thing that I will tell you too is lots of times people look at, I can't tell you how many times I've had a producer come up to me and say, you won't believe this. I had a client call me and tell me that they couldn't pay their premiums. And I was just having a conversation with them, asking them what happened. Well, I had a heart attack. I've been out of work for a while. I can't afford my premiums. And the client thinks that they're going to lose their whole policy. And yet, they have this great rider that they can use, and it can help keep their policy in force. So there's no restriction on what you use these dollars for. So you could turn around, accelerate a portion of your benefit, your death benefit, and pay your premiums with it. So most people forget that they even have these on their policy. And so it's a powerful benefit. The last one is the critical injury, coma, paralysis, burns, traumatic brain injury. Again, looked at the same way. Minor, moderate, severe, life-threatening. The reason we do minor, moderate, severe, and life-threatening is, remember, it's all about setting for claims purposes the life expectancy of that individual so we know how far they have to be discounted. We need to know as a company how soon are we paying these out versus when we would pay them out as a death benefit. So that's why we categorize these minor, moderate, severe, life-threatening. Typically, if you have a life-threatening critical illness or injury, it's almost a terminal event at that point as well. So they do overlap, and you can see when you look at the illustration that shows all the benefits that, especially the older ages for a life-threatening illness, the acceleration matches almost 100% the terminal illness benefit. Because at that point, especially for an older individual that has a life-threatening critical injury or critical illness, it's pretty much a done deal for them. The one difference I will tell you with the critical illness and injury riders are that the maximum lifetime benefit that you can receive in cash on this one is $1 million. And so the other thing that, let's say that you come in, your client has a severe heart attack, they accelerate 20% of their benefit, and 8 months later, they need more cash. They can come back in and they can accelerate more if they want to. They have up until the end of a 12-month period from when that critical illness or injury happened to accelerate as much as they want. Once that 12-month window closes, they have to have another critical event in order to accelerate more benefit at that point in time. Again, flexibility. They don't have to take it. It's there. Here's an example. This was a life-threatening, a 56-year-old that had life-threatening breast cancer. You can see, like I said, it's a very high percentage of what that value is. Now, one just word of caution as you start explaining these to your clients, and as God forbid you have some clients that want to utilize these benefits, one thing I will tell you, especially with cancer, if a client has a very aggressive form of cancer, if they apply for a full acceleration of their death benefit and they pass away, once they've applied for that acceleration, we have to do that acceleration. So I will just give you this one word of caution, especially with cancers, is that if someone has a very aggressive form of cancer, figure out what they need so that they don't give up that 10% of death benefit, because that 10% of death benefit could be a huge amount of money to their family. So that's the one caution that I will give you, especially when it comes to cancer accelerations for critical illness. Use as much as they need, because the death benefit is still a very valuable thing for their family. So, yeah.
Are these utilized on the drive?
All of this information, all of these, except for the claim stuff, is all out on our website.
Right, I know. Okay, so claims.
The claims are not.
Those are great examples.
And I don't know whether these are on we can put these, I can give these to Dana, he can put them out. These are actual claims, I got these from our claims department. There's no proprietary information here whatsoever. So I don't see any reason why you can't utilize those. No. Yes. So the question is, do we go back and rewrite after someone has one of these illnesses and give them a higher rating? No, we don't. Once a policy is issued, the policy is issued. That rate class is in force forever unless they come back in while they're healthy and apply for a better rate class. But no, we can never reduce the rate class of a policy once it's issued. So here's the, yeah. Okay, so what happens if the policy owner is not the insured? Fantastic question. This comes up, well, two things. Let me answer that question first. So remember, the owner of the policy, the premium payer of the policy, is the one that has been paying for the benefit and is the one that will receive the benefits, hopefully, income tax free. Again, I can't give you specific tax advice, but I can give you an example. Let's say that you had a corporation that was paying for a key man policy on a key employee. The premium payer was the corporation, the owner was the corporation, the employee was the insured. The insured has a life-threatening illness. The corporation accelerates the benefit, they get those benefits supposedly income tax free. If they were to pass them on to that insured, it would be just like the corporation stroking a check out of their bank account and giving that employee money. There will be a tax implication on that employee for those dollars received. So, another word of caution that I will tell you, and that is that more often than not, the owners and the insureds are the same. So let's take an example where someone is in a critical accident or has a critical injury from like a car accident. They're in a coma. The family needs these benefits. If the owner insured is in a coma, they can't affect that request. So one important thing with these benefits, especially as you start talking much higher benefit amounts, is they need to have something in place, some durable power of attorney, so that someone can act on their behalf if they are incapacitated and can't do this. Okay? So do the best thing for your client and make sure that everything is in a row, that all of their things are taken care of. Okay, so we've paid $87 million to 1,445 families since we started paying claims, since we started issuing these riders. So, if people ever ask, is it too good to be true, or does it ever work, or all that kind of stuff, ask these 1,500 families whether this made a difference in their life. I'm sure that $87 million that we paid out made a huge impact in those families' lives. So I'm running out of time. I think I'm running out of time. The last thing I wanted, yeah, go ahead. Yeah, Shirley?
No, I just want to comment. That line, 1,000 action, personal value, $4,000.
Yeah. Yeah, it makes a huge difference. And I've got hundreds of agents that have similar stories to that. The last thing I wanted to talk about really quickly from a distribution perspective, because at the end of the day, the way that I look at these policies is you buy the life insurance policy and hope that you don't pass away during your earning years and can take care of your family, all that kind of stuff. So life insurance is a critical component to making sure that everything stays intact. And then you fast forward, you get a little bit older, and then you're concerned about getting sick and losing your ability to earn a living. But then you get to the end, you've made it to 65, 70, you're starting to look at your cash value as a great pile of money that you can turn into retirement income because essentially you've won. I look at that, you get to the point where you want to turn cash value into supplemental retirement income, you've won the game. You haven't passed away, you haven't gotten sick, everything has worked exactly the way that we wanted it to. At the end of the day, cash value is just that, it's a pile of money, you want to turn it into income. So if you haven't looked at our lifetime income benefit rider for a distribution option for getting money out of a contract, let me just give you the numbers. And you can add zeros to these, you can do whatever you want. But in this case, this is a $400,000 policy. Was it a $400,000? Yeah, I think this was a $400,000 policy. There was $210,000 in cash. We could turn that into income of, this was an option B contract, that's why the initial death benefit was below. But it was about $400,000 when we did this. They could turn that $210,000 into $14,000 a year for life. Now, you may not think that that's impressive. Add some zeros to that, it becomes more impressive, but this is what's impressive. We've turned that cash value into a distribution amount that equals almost 7% of that pile of money. Think about that. You have a pile of money, and we can give you a guaranteed distribution of it of about 7%. And what's the other thing that we don't have to worry about when we're taking money out of a life insurance contract if it comes out correctly? Taxes. So in a 30% tax bracket, if you gross that up, it's almost a 10% withdrawal rate that we are guaranteeing for life for that policy owner. This is an incredible benefit. It comes on every case. There's no charge for it unless you use it. That person took out the policy at 45 and was 65 when he turned it on. So the withdrawal percentage is driven by how much cash do you have in your contract versus the face amount. That's what drives it. So if you have a well-funded contract and you're older, you get a high withdrawal percentage. If you haven't funded this correctly and you don't have a lot of cash, you're not going to get a big withdrawal rate. But remember, people are looking for stability. The number one concern of retirees in this country is running out of money. Number two, dying. They're more afraid of running out of money than dying. Think about that for a second. And this is a policy, and I'm not saying this is the end-all, be-all for everybody, but it is a solution for people that want to have some guarantee of income long-term. Because life insurance is, as you heard yesterday, what we're facing in this country, the only hedge we have against increasing tax risk moving forward. The only one. So if you guys aren't using this in that arena and positioning this for your client as a hedge moving forward, especially after all the scary stuff we heard from yesterday, then you're missing the boat. Permanent life insurance is the only thing that you can provide to a client that will give them that hedge. Thank you very much. Yeah. Can you turn the living benefit rider on and off? Yes, you can. Once you turn it on, you can stop it. You just can't increase it.